Now let's look at interest accrual for bonds payable. Interest accrual for bonds payable is very similar to interest accrual for short-term notes payable. What's happening here is that you know that we borrowed $100,000 on 1st of January 2012, and then we are responsible for paying $3,000 of interest every July 1st and January 1st of the subsequent years for 5 years. However, we have something that occurs between July 1st, 2012 and January 1st, 2013. That is our accounting year end, which falls on September 30th, 2012. If it's our accounting year end, because of the matching principle, we have to measure how much our interest expenses for the period between July 1st and September 30th and measure it as well as accrue it, which means record it in our books of accounting. Again, this accrual is very similar to what we did for short-term notes payable. In our interest expense account, we already have the $3,000 that we paid our bondholders on July 1st. Now, we need to calculate how much interest should be accrued for the period between July 1st, 2012 and September 30th, 2012. Again, we calculate interest by multiplying our face value of 100,000. You multiply it by the stated interest rate of 6%. That gives you an annual interest rate, but we are only calculating interest for 3 months now. So from July 1st to September 30th, that is 3 months. To calculate how much interest is for 3 months, we divide this annual interest by 12, multiply it by 3. That gives us $1,500 of interest for the 3 months. How do we accrue it? Accruing means we have incurred the expense, but we have not paid it yet. So we are going to debit interest expense for $1,500, and then we are going to credit interest payable for $1,500. So for your accounting year ended September 30th, 2012, you have a total interest expense relating to bonds payable of $4,500. You're going to report that in your income statement. The balance in your interest payable account is $1,500, and that will be shown on your balance sheet under current liabilities. Remember that also on your balance sheet you will have the long-term liabilities of $100,000, and that will be shown as the bonds payable. That is the carrying amount of your bond. Finally, let's take a look at what the journal entry would be on January 1st, 2017 to record the maturity of the bonds. You know that on January 1st, 2017, we are going to pay back the bondholders what we owe on the bonds. How much do we owe on the bonds? It's the face value, which is $100,000. What we're going to do is we're going to debit bonds payable, $100,000, and credit cash, $100,000. That is your journal entry. Let's look at it visually. Your bonds payable account has a balance of $100,000 on the credit hand side. That represents the debt that you owe your bondholders. On maturity date, which is January 1st, 2017, you're going to debit your bonds payable for $100,000, credit cash for $100,000. This will result in your bonds payable balance being equal to 0, and that is the entry to record the maturity of the bonds.